Welcome, my friend, to this Forex training. By the way, what I'm going to share here also applies to stocks, E-minis, and commodities and so forth, and future markets. What we're going to share with you today is something that is quite simple, but the dollars are on the details. So we want to give you the details here that, while keeping things simple, just a few little adjustments, a few little observations can help you avoid mental overwhelm and overload by keeping it simple, but then just a few tweaks here to make sure that you're doing it as professionals do and not overlooking some of these things and just trading general ideas that really are not quite detailed enough. You know, Einstein is attributed with the quote of saying, keep everything as simple as possible, but no simpler. So that's what we're trying to do here, is strike a balance. All right, so we're going to be talking about support resistance levels, and support resistance levels do work very well in all markets, and there is a good reason for that. Primarily, the reason is, and let's draw a level here. So let's draw one at this high here. All right. So what happens is when people see the market, when I say people, I mean the market participants, the market comes up to here and comes down. So now as people are going to be buying back, if they decide to do that, everybody in his parakeet watches that level. So this is one of the nice things about these support resistance levels based on previous major swing highs and swing lows. And here we have a daily chart. So that's a common time frame. So everybody sees that high. So you have the masses who are seeing this. So you're going to get a crowd effect. The mass psychology comes into play. And what's happening when the market comes back up to that level is people are starting to say, okay, well, last time we got up to this level, the general consensus of the market was that, no, we're not going to pay more than that, right? This price over here, that's what we're going to pay and no more. That's getting too expensive. Now, will sentiment change? Sure. Almost a month goes by, about 3 weeks or so goes by. So in 3 weeks, absolutely, sentiment can change and often does. But it's still in people's mind. They're looking at that. They're considering it. And so that's the psychology that's going on. Okay? And that's why of all the support resistance levels that there are, whether it's Fibonacci, whether floor trader pivot, if you're doing intraday trading, any other type of support resistance you might look at, I consider these major swing highs and lows on big charts like this, like daily charts, things that the masses are all looking at, to be the most significant and the most reliable support resistance levels of them all. So I often get questions that have the word best in them. In this case, it would be, Barry, what's the best support resistance tool to use? And this is one time that I have a clear answer, and it is major previous swing highs and lows. Ones that, when I say major, I'm talking about you just look at it and it visually pops out to every human being. All right? And that's it. Now, and so because it does have that mass psychology. Okay, now here's the problem. Now, as you look at that level, we see that, well, the market went through it, and then it went up to here, and then it went down to here, and then went down to there. So really, wait a minute, it didn't work. And that's because we drew it wrong. Great. Thanks, Barry, for drawing that wrong. Okay, well, that's to really prove a lesson here. So you don't do it at the highs. You do not do it at the highs, and you do it at the real bodies of the candle. The real bodies, for beginners, means these colored areas here, which define the open and the close, not the high and the low. And the reason that we draw them there, that's the professional way to draw your support resistance levels, is, again, the markets, and especially Forex now, this is again true of all markets, but I would say even more true of spot Forex than stocks and futures, because the spot Forex does not have a central exchange. So you are dealing with, first of all these different exchanges, all banks, people in all different countries. They're getting a little different price quotes, a little different spreads, right? So you're getting variances there. And then we've got millions of people. Some are retailers. A lot of them are amateurs, and they don't know what they're doing. So they're putting in orders all over the place and getting them in and out real fast. Then you got your banks, Then you've got your funds, and then you've got your professional traders that are scalpers. So you've got all kinds of different levels of traders, size of traders, nationalities, through different exchanges and brokers. So bottom line is, that means that the market, as you chart it, is not going to stop to the penny, the pip, or to the tick, in this case, the pip, at various highs and lows. You can't expect that. There's going to be a little more noise, a little more chaos there. So these highs here are that randomness, that chaos, that noise. And we want to, again, look at fair value, basically what the masses, the conglomerate of the mass psychology of all those people are finding as the value of this high, and that's going to be the real bodies. All right. So when we draw it there, now all of a sudden you say, oh, wait a minute, it does hold here. Now it doesn't hold the low, but again, we discard that. That doesn't matter. That's just a little bit of extra noise. It does, when you look at the real body of the red candle, for example, boom, there it is. Boom, there it is. Now look way over here. Boom, there it is. Wait a minute. I feel like singing a song right now. Isn't there a song like that? I don't know. Anyway, just happened to think of that. And so this is the proper way to draw it in order to allow for that noise, for that chaos, for that randomness, and don't expect these highs and lows to come in at the exact pip or, God forbid, the exact pixel on your chart, looking at it visually. So that's point one. Now, point two is when the market comes into these levels, look at your candlestick bars. And you don't need to use candlesticks necessarily, but I just think it's easier to see on candlesticks. And so again, we're taking that same principle now, and we're using it candlesticks. I'm not going to, again, this is meant to be a very basic lesson, so I'm not going to use candlestick terminology. For those of you who don't know the candlestick terminology, I'm going to just point out the principle. Again, the principle of it is when we get to these highs, look at that wick. That's called the wick or the shadow. I like to call it the wick because candles have wicks. So you'll see that the real body, the value is right there. That's where on this day, it opened and closed within that very narrow range, tested these prices up here and rejected them. And so that is a bearish pattern because we got that long wick up there, and this, again, this whole zone up here, that's a rejection of those prices. And that means that that is at least a short-term bearish pattern. And so that's what makes it put in a high and goes back down to support. Now, when we get back down to support, again, we've got a long wick down there. So it rejected that. That's a push off of the bottom and goes back up. When we come back up, we've got a long wick up there. Okay. And then here we've got a couple of long wicks. And now you will not get these kind of long wicks at every high or every low. So for example, well, actually we got one there, didn't we? Got a pretty good one right there. And it may not be right at the very high. It might come in at the second bar or so. But there's other types of candlestick patterns. There's engulfing patterns and things like that. So this is just one example that I'm pointing out. And there'll be others. If you want to study candlesticks in detail, actually, that would be a great idea. I highly encourage you to do that. Today, we're just pointing out a couple of things. So there you go. Now, when we break through this resistance level, notice how the candle just flies through it. There's no wick up here. Oops, I just took it away. Okay. So there is no wick up here. We actually closed up there. The open here and the close there. And so that's how it breaks through. When it comes back to support, the wick goes below. When it comes back to support, the wick goes below, but the close is above. Now, when we break down below that resistance, or this time now it's resistance that's turned into support, right? Now, when it finally does break through support, what happens? It closes below the support level, and the close is down there. The problem is, the question is, how do we determine when support is going to hold and the market's going to bounce off of it, or whether support or resistance for that matter is going to be broken and the market continues to slice right through. This is one way to do it. Look at your price action bars at those support resistance levels. This is one example. I do encourage you to learn more candlestick patterns in addition to these, and it'll give you more triggers. So If you liked the video, if it was helpful for you, please understand that, really, we all have a moral obligation to pay forward the things that are helpful to us because you're getting this for free. I don't charge for it. Please click on the share button below and pay it forward. Also, if you're watching on YouTube, go ahead and subscribe. That way you'll get notified every time I create a new video, which I do about once a week. Also, please click the thumbs up icon and leave a comment because that really encourages me to keep creating more free tutorials for you. I love the interaction. And finally, I have a special offer for my YouTube subscribers, actually for anybody watching this. I'm going to give you one of my favorite trade strategies, the whole trade strategy, all the rules, everything. It's called the rubber band trade. It's a great trade. I still trade it myself to this day. In fact, every time it sets up, I take this trade because it has a really high win-loss ratio. And it's a simple trade. It's one of the simplest trades I know. I can teach it to you in 26 short minutes, which I'm going to do. You can get it absolutely free by clicking in the image in the top right corner of this video or in the description below the video. There's also a link. And if you're not watching on YouTube or you're watching somewhere else, there's probably a link below or an opt-in form on the side. And once you do that, I'll personally email the video to you with the rubber band trade strategy.